This is the Aftermarket Radio Network. Carm Capriato here, the pioneer of Automotive Aftermarket podcasts with over 1,000 informative episodes and a great surplus of episode videos on my YouTube channel. Hey, we cover everything automotive aftermarket, you know that, and I'd appreciate you recommending the podcast to a friend. Hey, what is going on in overall mergers and acquisitions? What are buyers looking for? Why are so many family-owned businesses selling? Well, all these questions and more are answered in this episode as Rick Schwartz from Schwartz Advisors makes it easy for you to understand M&A. Thanks to our partners Apex and Shopware for providing this episode. The chance to nominate an outstanding shop owner, service advisor, and technician of the year has arrived. These annual Apex Awards are designed to recognize those who go above and beyond. Love you to do this. For details, go to aapexshow.com/service awards. The nominations are due Wednesday, September 1st, 21. How much paper have you touched today? Those are piles of time stacked all over the shop. Think of what you could do with all of that time and how many more cars you could get through the door. Cha-ching! It's time for a digital shop management system on the web at getshopware.com. Hey, one incredible honor for the podcast was earning the Mort Schwartz Excellence in Education Award. Now, Mort is Rick's dad, and I did an interview with Mort in episode 332. I think you'll really like it. Hey, a warm welcome to Rick Schwartz from Schwartz Advisors and Mort's son. Rick, I know it's difficult to bask in the light, in the shadow of your dad, but if you can look behind me, there's this Mort Schwartz Award that's up behind me, and it's in a perfect position because in 2017, I was so honored to win the Mort Schwartz Excellence in Education Award, and then I interviewed your dad, and then I met you, and you're one of the foremost M&A people in our industry. Now, what does that mean, everyone? Mergers and acquisitions. So you're here because I'm curious as to what's going on post-COVID, who wants to buy who, consolidation, succession. It is like if you asked what are the top three things, Rick, going on inside the service aftermarket, in the top three is either consolidation or succession, and you're right in the thick of it.
Well, first of all, thanks for inviting me back, Carm. It's good to be here, and you earned that award, the Mort Schwartz Award. So,
thanks,
congratulations once again.
Love your dad. Now, here's what we're going to talk about. Rick has brought some valuable information. Let's just set up this next little bit. What's going on in the overall M&A world, not just in the aftermarket now? Do M&A trends in the aftermarket track with the big picture M&A activity? That's kind of neat. What's going on big picture, what's going on in aftermarket? He's also going to talk about what's driving M&A in the service sector. Listen up, from a buyer's perspective. And what are the buyers looking for? That's going to be fascinating. And no matter who is selling, what preparation is necessary? Man, we talk about this all the time. So look, topic number one, what's going on in the overall M&A, not just aftermarket?
I could go on for hours about what's going on in overall M&A, so I'm going to keep it brief because it's really fascinating to see what's going on in the total economy. Really mirrors what's going on in the aftermarket. But what's really exciting is to see what's going on in the nitty-gritty when we start looking at parts of the aftermarket, like the service segment. So let me just give you a couple of 30,000-foot views of what's going on in terms of overall M&A. First of all, we're seeing record deal flow so far in 2021. And many of the different people that we talk to, investment bankers, private equity firms, and other people who are involved in mergers and acquisition, are reporting record deal flow in terms of the number of deals they're seeing. And it's really interesting to see what's happened over the last, almost 18 months since COVID happened. Because what happened in 2020, as we all know, the economy came to almost a standstill when COVID really hit us hard in March, April of 2020. So what we had is all deal activity, for the most part, was coming to a halt. Now, there were deals that were in progress that did get done. So we had probably 4 to 6 months of virtually no deal activity. Then in the end of 2020, maybe starting September-ish, The deal activity came back with a vengeance when companies saw that the economy fundamentally was in good shape. We absorbed the hit of COVID. The economy came back. So a couple of quick things. Why is deal activity so strong this year? Well, first of all, there's a lot of catch-up. Deals that did not get done in 2020. Sellers want to get those deals done this year. Second thing, a lot of the buyers, whether it's private equity firms, these private investment companies, or independent companies or publicly owned companies, they're all sitting on a lot of cash. In our world, they call it sitting on a lot of dry powder.
Dry powder. I call that pent up.
It's the same thing, I guess. Depends on what your perspective is. But a lot of people are sitting with cash on their balance sheet that has been allocated for acquisitions, and they have to use it for acquisitions. So we're seeing a lot of the buyers. They have been sitting, waiting impatiently. And now when the economy came back, when the election got done in the fall of 2020, a lot of deal activity right now. We see the potential impact of tax changes. Nobody knows what's going to happen. Congress is not the most functional body in the world, especially right now. But there's definitely going to be some discussion about tax changes. So some sellers want to get deals done in 2021 ahead of any potential tax changes that will take place next year. Sellers want to get deals done. Now, we also are seeing low interest rates. Now, for years, I've been hearing people say interest rates are the lowest that they're ever going to be. So I'm not going to say that because I don't have a crystal ball. But when interest rates are low, Carm, it makes it easier for buyers to finance acquisitions. So a buyer can get a deal done and maybe pay more when interest rates are lower because they can finance it. Differently. So as long as interest rates are low, then you're going to see a lot of deal activity because it costs less for a buyer to get a deal done. Now, there's some rumblings right now in the economy of inflation. So as inflation comes and interest rates go up, it's possible that the deal activity will slow down a little bit. But right now, valuations are really high for a number of the factors I mentioned. There's this excess dry powder. Deals didn't get done last year. There's a lot of deals coming to market, tax changes. So a lot of different reasons why we're seeing deal activity.
Rick, let me ask you a question. Private equity money looks at the aftermarket as essential. Is that attractive?
Oh, yeah. Well, look, the private equity world, sometimes gets a wrong reputation as being a bunch of, cowboys and guys who are, taking on huge amounts of risk, when actually the opposite is true. Private equity looks for deals that they can model out and say, over the next approximate 5 years, and it could be 4 years, it could be 10, but 5 years is the standard. What kind of growth can we expect from the company we're considering buying? And they want to be able to model something that says, if we buy it for X and we do certain things to help the owners, the management team build the business, what can we expect in terms of growth over the next, 5 years? When the private equity world looks at the automotive aftermarket, they look at a VIO of over 280 million vehicles, and it's going to be 300 million soon. They look at some of the recent statistics that have pushed the average age of vehicles over 12 years. So when a vehicle is over 12 years, it needs work. It needs to go into the aftermarket. It's not going to go to the dealer. If I own a car that's 12 years old, I'm not going to take it to the dealer. I'm going to take it to the independent aftermarket. And they look at replacement rates. 12 years, things happen, whether it's, collision repair or just getting brake job. So the private equity world really likes the aftermarket because, quite frankly, you can look at a lot of parts of the aftermarket and say it's got slow, steady growth. And slow, steady growth actually is very attractive to private equity.
Does private equity like to pay a deal back in 5 years?
They like to pay it back in at least 5 years. Every private equity firm has a different flavor in terms of how they look at things, but the standard is 5 years. And sometimes they like to get it done sooner. Sometimes they're willing to hold on to businesses for as much as 10 years. They're not in a rush, but 5 years just becomes the benchmark for how to think about an investment. Will I be able to make my money back and then make a profit in 5 years?
Private equity isn't looking to buy and sell. Are they looking to buy and build?
It's both. So every private equity firm has to sell the businesses they buy because they get money from their investors, large pension funds and large investment companies. So if I'm a private equity investor, I have to go out and raise tens of millions of dollars, hundreds of millions of dollars, whatever the size of my fund is. I have to pay that back. So the way I pay that back is when I eventually sell the companies that I buy. So I have to sell everything I buy.
I did not know that. That is interesting.
Yeah, so every private equity acquisition, if it's a private equity firm, will be sold. But the really good firms are looking to build a company that they buy and leave it in better position than it was when they bought it.
Okay, so I'm a guy who owns a dozen shops, and I control 60 bays, for example. And I got a great business. I got a good net operating income or EBITDA. They offer me a great multiple. I'm going to own the property, long-term annuity thing, all that stuff, right? But my peoples may have a new owner in 5 years. I mean, if I care about my peoples, do I really want to do a deal like this?
There's no yes or no answer to your question. It really depends on you, the business owner, where you're at in your life, what your objectives are. And a lot of the people that we work with in our line of work, they do care about who they sell to because they want to leave the business with a new owner who will take good care of their people. And we love those kinds of opportunities because there are a lot of really good buyers who can do a lot to help build up the business. Sometimes if I own that 5-location, 60-bay example you gave, I may not be able to offer the best benefits. I can offer the benefits that I can afford. But if I'm selling to a bigger company, maybe they have a better health plan that they can bring in. Or maybe they can bring in some better things like a 401k that maybe I can't offer. So sometimes a new owner can do some things that help with retention and also help with recruiting new people.
Yeah, well, I believe that a 12-location, 60-bay operation would have a 401k. They would have great health benefits. If not, they couldn't recruit the talent that helped them build that business. And, okay, I don't want to belabor that. It could be a different episode that you and I could, get on with some people and actually discuss this because, of course, the owner who definitely cares about his team and his people and where they land on their feet and that they have gainful employment for a while, he still may have an opportunity to, cash out. That's why he works so hard.
Yeah, but, think about this, Carmen. The world is getting more competitive all the time. And if I'm that guy who owns, 10, 12 locations, I've got to constantly be thinking about how am I going to bring in enough vehicles to keep the bay productivity going. And maybe a new owner, if they already have some shops in the next market, maybe they can do some more creative marketing that will keep the bays busy, or maybe they can do some load balancing where if one of the locations is really busy, they can send some of the vehicles over to, the neighboring location. So as a business owner, I may look at this as an opportunity, one, to cash out and do some estate planning for myself, but the next owner may be able to do a lot to help the people, keep them busy, and eventually maybe even bring in some more people, do some recruiting.
The next owner would have a growth strategy, no doubt, because obviously if the business can return the investment in 5 years, that's usually never just enough. It needs to grow and get bigger. So, to your point, I think the opportunity for the team, you're right about the benefits issue, but some of the team could grow into bigger leadership positions. Yeah,
no, if I can put on the hypothetical hat on the buyer, one of the first things I'm going to ask is, if you, the owner, you're going to transition out of the business, if that's your plan, who's there that we can groom and have take over? Who can be the overall person running the business? What about individual store managers or even maybe some regional managers if you're big enough where you need to have a couple of regional managers? I think you're absolutely right, Carmen. It creates some opportunities for the staff.
We're doing a show coming up, Second in Command, where a lot of the leaders of our industry are starting to realize that their role of the visionary could allow them to think bigger, better, different things, growth. And in order to get the day-to-day done, they've got to have a good COO or second in command. So that's a big trend going on with our most smartest operators.
Absolutely.
Family-owned businesses, as we had just said, the reasons that they may be succeeding or selling. Can you offer me some advice on that?
Why are family-owned businesses selling? Well, there's a couple of different dynamics that we see. First of all, could be timing. So it could be that the business owner is just at a point in his or her life where they're ready to sell the company. It's not related to any of the economic trends that we were just talking about. Maybe they don't have a second in command, or they don't have another family member to take over. So it's timing. Another thing that we see is competition. Sometimes, I hate to say it, but in some markets, bigger is better, because bigger gives you just more economies of scale in terms of purchasing, pricing, marketing. So it's possible that as a business owner, I might look at the market and say, geez, it's going to get a lot tougher in the next couple of years. Another thing is, if I own real estate and I also own a business, I have to ask the question, do I want to continue to operate my business? Or do I want to sell to someone who will then lease back the property that I own, so I become a landlord instead of, an operator? So I think there's a lot of different things. And certainly, we already mentioned tax code changes, but as a business owner, I might look at the landscape of competition, tax law changes, and also knowing where I am in my life. If I'm at a point where I've said it's time to hang it up and go fishing, I might look to sell. But if I'm still young and, I've got a lot of fight in me, I might say, I'm going to hang in there for another 10 years.
Carm here, and coming up, what is driving M&A in the service sector from a buyer's perspective? Hey, Carm here, and I'm excited to announce the chance to nominate your favorite shop owner, service advisor, and technician of the year. These annual Apex Awards recognize the superstars among us in the industry, and those are the ones who drive the industry forward, serving as role models and truly go above and beyond to help keep the world's 1.4 billion vehicles on the road. To nominate a shop owner, service advisor, or technician, go to aapexshow.com/service awards for more details. I'll put this link in the episode's show notes. Apex has lined up an independent panel of shop owners and industry leaders to review the nominations and select the award recipients. The best of the best will be announced November 2nd during the opening keynote session at the Sands Expo in Las Vegas during Apex. Don't wait. Do it now. Nominations are due Wednesday, September 1st, 2021. Hey, look, I know that you know of a deserving person. Are you stuck in small ticket rut? Well, that's exactly what happened to Dominic Linden and the team at Autobahn Service in Sheffield, Massachusetts. With the busy day-to-day bustle of shop operations, they didn't have time to chase customers for approval. They were caught in a cycle of low AROs, and they were losing those higher ticket jobs to competitors. Autobahn Service was introduced to Shopware, and just a few months after going live, the shop was so busy with new jobs that they actually needed to lower their car count. They are now able to be selective with the services they take on, and profits have never been better. Additionally, by tapping into Shopware's digital estimating capabilities, Autobahn Service has noticed an 89% average approval rate from customers. Their average RO before Shopware was $450, and now it's up to $700. Now that's a 55% increase. Do the math. Reach your customers faster and get approved dollars up. GetShopware.com. There's so much pent up, as you were saying a little earlier. Put your vision glasses on. How far out do you see the level of, I don't know if it's the words excitement or pent up pressures? Is it going to go out 2 or 3 more years?
Oh, I think it's going to be going on for a while, yeah. I mean, you look at just the number of independent service locations there are across all segments, whether it's, undercar, tire, combination. Even we still see a lot of transmission shops. And even though transmission drivetrains are changing, there's still a lot of internal combustion engines. So transmission, collision, there's still a lot of independent collision centers. So I think if you're in any part of the service business, we're going to see a lot of M&A activity for quite some time.
You know what I find the wild card here in my mind, and again, I'm nowhere near your pay grade, but it's that whole tax code thing. And so if I ask you, hey, Rick, does this thing happen at the end of the current administration's run? Does it happen during it? The dysfunctional, Congress? Do you think we have to worry about that in the next 3 years?
Oh yeah, and the big variable you just said it is Congress. And look, this is not a left, right, center, blue, red. It's not any kind of those issues. It's simply a matter of, I think, there's definitely a call from a lot of different parts of the economy and across all parts of the spectrum that we need to look at the tax code, and there needs to be at least a rational conversation about what is the best tax code going forward. It's possible that there won't be any change, but I think the current administration is looking to make some changes. Some of the proposals that they've thrown out probably are not realistic, but it's a starting point for them to get the conversation going.
What's driving M&A, mergers and acquisitions, in our service sector from a buyer's perspective? And then I want you to talk about the seller's perspective. So let's hear some great wise words of wisdom here.
Carmen, it's like a land grab for growth. We see companies that are taking a look at how much they can expect to grow on just a what we call organic basis, same store sales growth. And then we see a lot of people saying, buyers saying, geez, we need to grow faster than we can grow by just keeping the same number of locations. So growth beyond simple organic growth. So you see people buying because that speeds things up. And that's because there's pressure from Wall Street. There's pressure from, owners. It's just a land grab. We're also seeing buyers buy businesses because they don't want to get beat out by their competition. We're seeing some of the big guys in our industry say, geez, we're going to buy that 3, 4, 5 store chain because we don't want somebody else to buy it. People are looking to buy distribution.
Are we ever going to get to the point where we're going to have a whole lot less in the distribution field? And because of that, are we going to have less and less outlets to buy stuff from?
I don't know if we'll have less outlets, Carm. You'll have less outlets in terms of there'll be fewer WDs. We're definitely seeing consolidation and rationalization of WDs. But the WDs still fill an important function where they got to get parts within 30 to 45 minutes. Unless you're buying a WD that completely overlaps existing distribution points, I think what we'll see is maybe a loss of some back office jobs, but you're still going to need the distribution points to get the parts to the guys who are turning the wrench.
So I get that whole service sector from, a buyer's perspective, but let's put a bow on this thing. What do we as a service sector industry who may have an opportunity, maybe not doing a sale from into a really big, say, private equity firm, but just plain old selling to the guy who owns 6 stores and he's looking for his 7th. What do they need to do to prepare?
It's a great question. And I think the preparation is the same no matter who you're thinking of selling to. It really doesn't matter. And it starts with preparation, Carm. Best time to think about selling is when there's no potential deal on the table, because it gives you a chance to get your house in order, as it were.
Rick, that is so smart. You need the right advisors. You need a good profit and loss statement. You need an exacting set of books. You need a leadership team. I'll stop there and let you finish.
You're spot on. I think about your business and, you probably, as a business owner, you probably know everything off the top of your head. You know exactly what's happened, but the buyer, whether it's your buddy in the next town who wants to buy your business or a private equity firm or someone in between, they don't know that. And unfortunately, they're not going to just take your word for it. So you've got to have at least 3 years of really good records, preferably 5 years, copies of your tax returns. You need to have financial statements. You need to just have really clean financials, copies of all your leases and contracts. You just need to have all the paperwork. It's simple stuff.
I hear that more often than not, where the buyer goes to, a fella that he knows, say two towns over, And he says, hey, I heard you were interested in maybe retiring and selling. He says, and they have coffee and they have small talk. And he goes, I want $1 million for my business. And you and I were on a panel at Apex, and we talked about that. I mean, that is one of the, rollover laughing statements that happens all the time, but there's not enough people that it's getting through. They're understanding it. And then once he gets off the fact that the business has to be evaluated, and then he says, what do you mean I need tax returns? What do you mean I need a P&L? What do you mean we have to normalize this? What do you mean I need my rent and my lease? I own the building. And as you say, if you're going to sell, you need to start preparing, and it could take a year to bring everything together.
It really could, Carmen. It's, I'll give you a couple of, examples of things we've seen that can easily be cleaned up, but sometimes buyers will think of it as a red flag. Let's say, you're just behind on some of your, sales tax payments to the state or some other property tax if you own the property, just basic things, payroll taxes. I hate to keep bringing up the tax word, but, there's all these things. If you're behind on anything, just because, whatever reason, a buyer is going to say, hey, I can't do this deal until you take care of some of those tax issues. It's just simple doing business. Let's say you have a workman's comp claim. It happens, hopefully you have workman's comp insurance. It's simple things like cleaning things up. Doesn't mean you always have to give in on, claims, but you have to make sure that you're doing your best to just take care of stuff. Because there's this word due diligence, which I'm sure you've come across, Carm. And when a buyer is doing their due diligence, which is the examination of the business, when they've made an offer, you as the business owner have accepted it, and you've agreed that you're going to let the buyer do some analysis. That's called due diligence. Things come up. They always do. And the more you can do to anticipate some of these questions or clean up some of these issues, it's even literally cleaning up. One of my partners used to own a big WD, and he's a stickler for making sure the WD, everything, the boxes are on the shelves. He doesn't like seeing any boxes on the floor or things that are messy, because to him, a messy warehouse at messy DC is a sign of a messy business. Now, is he right? I don't know. But, literally clean up, because when I come through and examine your place, I want to see your 5, 6, 7 service space. I want to make sure the lift is working. Simple thing. Show me that the lift works, that the garage doors close. Put your best foot forward.
I love that you said due diligence. I've done a lot of due diligence in my life. Not only when I worked for corporate America, and I was on an acquisition team, and I was one of the people that took all the data that we got and tried to prove it to be right and find out stuff. But I want to go back to one of the things you said about making sure your tax stuff is clean. If I was buying the assets of the business, does that matter versus if I was buying the stock of the business?
It does. Well, let's talk about what that means. So when you're buying the stock of a business, you're basically buying the corporate entity, and you absorb all the liabilities, everything that the company owns. So if I'm buying Carm's corporation in a stock deal, and Carm hasn't paid his property tax or his sales tax, I am assuming that. But if I'm buying the assets of the business, I'm basically just buying the physical assets, and you as the seller retain the corporation. It's possible that we can get a deal done where you still may have some sales tax that you owe to the state, but we have to make sure the contract is clear that me as the buyer, I'm not assuming that. It creates a complication that can slow things down, and there's no need to slow it down because it just gets in the way of the deal. So technically, you bring up a good point. If it's an asset deal, you may not need to clean it up, but it could derail the deal, because I might look at that and say, geez, if you're not cleaning up that issue, are there going to be other things that I'm going to find?
That's a CYA, right?
It's a CYA.
You cover your butt, that you may have to, I don't know, would they write language in a contract to cover that?
Yeah, there's things called indemnifications, which basically is the guy who's selling the business basically says the buyer is not going to be responsible for X, Y, and Z.
Here's the bow I want you to put on this as far as advisors, the kind of people that I need to have on my team. Now, if I was sitting down with a potential buyer in this merger and acquisition kind of mode, I don't want to bring my real estate lawyer to the table, do I?
No. We're an advisor, so, want to make sure that we completely, are acknowledging what we do. But here's why I think it's important to have really good advisors helping you. One, a good advisor has a sense of the landscape of what buyers are paying. So you want to make sure that you have someone working for you who knows what valuation trends are. That's the first thing. Second thing is people who are a good mergers and acquisition advisor, whether it's a lawyer or a firm that does advisory work, they know all the ins and outs of transactions. And there's just a lot of deal points in transactions that need to get done. So you want to have someone who can help you get things done efficiently. But, one thing that we like to say, the saying, Carm, you never want to go to a sausage factory and see how sausages are made.
Yes, sir.
But, when you get the sausage and you cook it up on the barbecue, it sure does taste good. Selling a business is like making sausages. It's always a little bit messy. There's always going to be some twists and turns and things that come up that are just unexpected.
Something in there that you didn't expect.
And it can be the most frustrating process any business owner goes through is selling a company. But if it's done right and it's done efficiently and you have some good advisors who are taking the hits for you in terms of all the stuff that has to be dealt with, you can have a really tasty, end result in terms of getting the kind of deal you want. And by the way, you can sell that business for whatever the selling price is, $1 million, $5 million, $10 million, and you can have two different deals sold for the same price, but there'll be different tax consequences. A good advisor can work with your attorney, your CPA to try and structure a deal where you pay less in taxes.
You just said the magic three letters, CPA. You don't want your bookkeeper or someone who isn't a certified public accountant to help you determine how to structure a deal either. I mean, there's so many clever things that can be done.
A good CPA will know a lot of how to structure a deal, but they may not know how to negotiate the deal. You need to bring in your CPA eventually because there's some information that the CPA can usually provide to an advisor. But having a really good advisor, like I said, they know how to get a deal done. And their interests are aligned with your interests as the business owner. It's not easy selling a business. Some people have been able to sell a business without the help of an advisor, but sometimes they don't know what they're leaving on the table. And plus, it's very distracting. If you're still running a company, where are you going to find the time to sell a business?
Okay, it begs the question, a great M&A advisor, of which, of course, your company is, and I have a small little $800,000 shop. I'm sure Rick Schwartz and Schwartz Associates are not going to possibly be interested in that. But you kept saying seller, seller, seller. But if I was the buyer, would it be advice to have an M&A specialist on my side?
Yeah, and sometimes they're in-house. I mean, sometimes they're actually on staff where if it's a big enough buyer, they might bring in somebody who's all they do is acquisitions.
But I have 3 stores. I'm going for 4. There's a guy three towns over, and I want to buy this thing. And yeah, I have 3 experiences under my belt. I'm getting better at this. And I guess I trusted my accountant to help me do my first one. I trusted my attorney to help me with the other one. The bigger I get, the more complex, the more complicated, the bigger fish I'm looking to buy, then you would recommend maybe somebody who could see it at a higher level?
Yeah, and we've done some work before with some chains that are growing, and they just don't have time to go out and bird dog new acquisitions. And so sometimes it's helpful to have a good advisor who can be in the market looking for deals. If you're the buyer, you may not want the world to know that you're buying until you're actually talking to someone specifically. So you might hire a good advisor to say, hey, go out and find me 50 possibilities, and then we can narrow down the field from 50 to 10.
Cool, I get it. Hey, I so enjoyed this. We have talked about this on the podcast a lot. And I think it's important that you came and brought an M&A's perspective, and it's the first time you've been on, and we specifically talked about this for 30 some minutes now. So I really thank you. And I hope our listener leaves respecting the process, understanding that it's hot right now. We know it's hotter than ever. The graying of our industry and the opportunity for people to amass bake count in an essential industry at every level, from the beginner shop who wants to add his second, and the ones that have a dozen who they want to go out and add 10 more. So, Rick Schwartz, thank you so much from Schwartz Associates. This was wonderful. I love, the title, if you will, on your website, the Motor Vehicle Aftermarket Experts. How cool is that?
Well, thank you. Well, great to be here, Carm, and love to talk to you about what's going on in the aftermarket. It's our favorite topic.
Come back when the tax code changes, and we'll talk about it.
Oh, definitely. Definitely.
Gee, thank you so much, man.
See you at Apex, Carm.
Thanks for being on board to listen and learn from the premier automotive aftermarket podcast. Until next time.